Thanks for having me today. Wish we could all be there in person. That said, kind of spoiler alert, I've been doing a lot of road shows and client meetings around the country. I typically travel the Eastern Seaboard, but in the last week, hitting various cities, Fort Lauderdale yesterday, New York on Friday, Connecticut, and Baltimore in the last week. So I can tell you that there's a lot of people moving around and doing stuff, which is not recessionary. So spoiler alert, I don't think we're going into a recession. I'll give you the reasons why I think that we're not. That's not to say that we aren't having real inflationary pressures. But I think the take home here again is things are inflationary, but they're not recessionary. So let me buzz through that, and then going to leave some time for us to do some Q&A if possible. So kind of upfront here, where I think things are going. The teal part of the bar is there showing you my forecast. This is for real GDP or gross domestic product, all our economic activity, goods and services and purchases on a real basis, which means inflation adjusted. So I'm going to show you another slide here in a second, showing the differences very quickly. But this faster inflation and certainly a faster response from the Fed as far as rate hikes and normalizing things, I'll get to that in a second. But that certainly eats into this real part of economic growth. But that's not recessionary. And again, that's what I'm going to talk about through the course of my time here today. On the left side here, showing the upward move in inflation. This is just one of many inflation gauges. This is core price, personal consumer expenditures, or PCE. This is the Fed's favorite gauge. But again, just showing you consensus numbers, not showing you my numbers to see, hey, this is what everyone thinks, if you will. And we've seen a very dramatic, this is year over year change for the full year of 22. So I know it might feel or seem a little bit low comparatively because we're getting these 8% readings year over year to begin this year. But as the year progresses, if I showed you the quarterly numbers, you would see that most everyone agrees with my general assessment that here in the middle of the year, we're going to see a peaking of those inflation numbers. That said, inflationary pressures are going to remain. It does stay high, just from a comparative sort of basis. This is better than double where we were pre-pandemic, and really the decade plus before the pandemic. So there's a bit of recentism here where people, particularly younger people that have never, ever seen, never have I ever, as the kids say, never have they seen inflation. Those of us with a little bit of gray hair know that inflation is a thing. We just haven't seen it for a while since the great financial crisis. But lo and behold, it is back. So nonetheless, here we've seen the left side that inflation expectations are pushing higher. On the right side, I'm showing you the difference between nominal, or the real time, what gross domestic products is expected to do. And as you see over time, the expectations for the full year of 2022, even as we moved into 2022 here and had the Russian invasion, and I'll touch on that in a second, you see that growth expectations aren't going down, they're actually going up. So more economic activity and more growth. On a real basis, which is the lighter purple part of the bar, you see the real numbers, inflation adjusted, are coming down. And that's because there's a bigger piece of inflation eating into that nominal growth story. So it's a little nuanced, but an important point to make, that overall growth isn't going to be negative, but real growth is where we're seeing that pinch from inflation. Here's another way of looking at it. These are my stoplights, looking at many of the flags or indicators that we look at to say, hey, do we have a recessionary sort of indications? And really the only one, which is crude oil, has seen this dramatic year over year increase. And that year over year increase certainly flashing red. That's a condition that does tend to flag a recession, but in and of itself, none of these indicators is a cause, certainly, but they do contribute to the conditions that tend to lead to a recession. But as you can see, running your eye down that right column, most of them, not only are they not yellow, most of them are green and continue to point toward continued growth. And again, this is just a smattering of those indicators, but these are the key ones looking at them. And particularly on the labor side, employment side, not only do they look strong, they look very strong. So they all point towards continued growth, which is why we say near-term risks, call it the next year, 18 months, even 24 months. We don't see a recession here. Can we see a negative quarter get, lumped in there along the way here, particularly early in 23? Yeah, it's possible, but two consecutive, no. And the conditions for a broader recession, particularly with some of these pieces of the economy that are very important. I'm going to go through housing in a little bit, but certainly I mentioned employment and other things, capital expenditures, those sort of big ticket purchases that businesses make. Again, when we start looking at backlogs and where things are at, it's not recessionary, people. And then when we look at some of these real-time indicators, whether we're talking about weekly jobless claims or passenger throughput for TSA screening checkpoints at airports, again, not at pandemic highs, but all-time high. So they're working their way higher, which is a good thing. Here's one kind of illustrating that. This is my famed spaghetti chart. This is talking about the total number of workers, and you can see that dark truest purple line showing you how really V-shaped this recession and recovery have been on the employment side, comparing it not just to the great financial crisis, where it took 5 years to get to roughly where we're at today, and roughly 6.5 years to get back to the zero bubble. But giving you more of a kind of garden variety recession, the 2001 recession, you see that it took roughly double the time for us to get to where we're at today, and roughly 3.8 years, to get back to the zero bubble on the number of jobs. And we've done that very quickly in roughly 2 years this time around. And if we put all the recessions on there, going back 100 plus years, we've never seen this sort of recovery. It's unprecedented on many levels. There's a number of reasons for it. Yes, there was stimulus and fiscal stimulus and stimmy checks and those sort of things that happened. Yes, there was unprecedented response by the Federal Reserve. Those certainly contributed to the speed of it. But I would posit to you, the US economy was on strong footing prior to the pandemic, and was easily able to go back to long-term trends. We're getting this short-term bump up for the next couple of years, and we're going to go back down to that longer-term growth rate. But comparative, you look at what the rest of the world's going through, particularly parts of Europe, and again, excluding what's going on because of the Russia deal, that 2020 and 2021 were not the same sort of path, and their recovery doesn't look the same as ours. So it's hard to compare, not just to ourselves in historical context, but also real time against our peers, particularly Europe, but also Japan and others, that we've had a recovery, particularly on the employment side, that's nothing short of remarkable. Similarly, looking at retail sales, again, it took years for those to recover the prior recession. If you look at the 2001 recession, it really didn't go negative for more than a couple of months. And then you saw that it bounced higher, but the strength of retail sales, and this includes food sales as well, but retail sales overall have continued to grind higher. And again, not just back to pre-pandemic levels, they're at an all-time high, and it's 26% above pre-pandemic levels. The pace of that is going to start to taper as we move forward, but nonetheless, overall sales continue to grind higher, which is an important view. That said, we are seeing things, and I mentioned fallout from Russia is becoming very apparent, particularly in some of the key commodities that are globally traded, like natural gas, but also things like wheat, nickel, and fertilizer. Fertilizer has a double whammy. It comes from crude oil and natural gas, and then it gets fed back in with crude oil again because those commodities get shipped to their final market. So there's kind of a double whammy again with food inflation that we're definitely seeing, and that's going to continue for quite some time, not just because of the Ukraine, but overall increase in crude oil prices that we've seen. Core inflation here, ignoring or setting aside, excluding crude oil and energy, but also food. And you can see that overall the pace of core inflation, this is on a year over year basis. We've seen that start to level off, and pieces of it are starting to move down. Within the lighter purple part of the bar is new and used vehicles. Almost 3/4 of that is used vehicles. If we look at the total year over year change in inflation, a big chunk of that, almost a third, has been on itself just used car prices. I'll go through that in a second. But nonetheless, we're starting to see that already peak and move lower. And then in the teal part of the bar is everything else. The vast majority of that is housing, and I'll touch on that, of course. But again, we see that the pace of core inflation is starting to level off. It doesn't mean that we're seeing a rollback in prices. You're not going to see a rollback in prices of many of these goods. So I know you had your eye on pick a car or SUV that you want to buy. Yeah, the price isn't rolling back, but you aren't seeing the increase in price continue to stack up on top of it. And that's the important factor that we're looking at. We've also seen a bunch of global central banks beginning to start normalizing policy. A lot of people are looking at this in a vacuum here in the US and saying, geez, the Fed's pushing ahead and doing all these things. This is the number of central banks that have been hiking versus the number that have been easing. And you can see we've seen a dramatic increase in the number. Certainly the Fed is the most important on many levels, not the least of which is because this is where we live, but also the implications for the dollar and other pieces, very important. Nonetheless, the Fed is starting to move forward. That said, I think, again, there's some context that's lost in a number of these conversations, not the least of which is, and I'm starting to hopefully paint the picture for you that the US economy is not in crisis anymore. Well, our monetary policy doesn't need to be in crisis mode anymore either. So the need to keep interest rates at zero or near zero is no longer necessary. And as I mentioned, some of the inflationary pieces, it's important that the Fed begin to start normalizing rates. The other piece that I think a lot of people, again, nuanced, but important piece that people are driving right past is even if the Fed's raising rates rather dramatically in a shorter period of time or sooner than people expected, conditions are not tight by any stretch of the imagination. Whether we look at mortgage rates or other things, yes, we have multi-decade highs, but we were depressed for quite a long time after the great financial crisis, and I'll show a little bit more about that as we move forward. But nonetheless, it is important for the Fed to begin normalizing rates as we move forward. And again, it's happening not just here, but also around the world. This inflation dynamic, there's another piece that's lost in the shuffle. This is the difference between big ticket spending, durable goods, and spending overall from consumers on services. And we see that we're still below the zero bubble on services. And this is flipped around. It shouldn't be this way. Additionally, we're still, about 22-23% above the pre-pandemic level as far as spending on big ticket items. This is things like automobiles, but also appliances and those sorts of things. And the other important factor that I would, again, point out to you is notice the difference of the magnitude on each. So the left side, top out at around 3 trillion. And on the right side, you see that it's 3 times that size. The spending on services within the US economy is literally 3 to 1 on services versus durable goods. So again, this is among the factors of why we think that this shift from goods to services, and services don't have supply chain issues the same way that goods do, is going to help with the inflation dynamic, but also this spending on services that continues to rebound, but also has a lot of pent-up demand, is going to continue to drive economic growth as we move forward. So again, kind of a two-pronged reason why we're encouraged by this dynamic shifting back to a more normal situation. Which kind of brings us to what's the wherewithal with consumers, and what can they afford, and what's going on with all this this money. So some of it certainly was stimmy money that came through, that went largely to the bottom 35% of the income spectrum. So if you're looking at this graph, the farther right 2 bars, and as you can see, yes, the bottom 20% of the income spectrum has already burned through their change in cash balances. These are, again, checking and savings and money markets, nothing else. This is just the change, not the total. If we looked at the total, it's north of 4.5 trillion with a T. And certainly when you put T's on the back of the numbers, they move the needle. But the take-home point here is that, yes, the bottom end of the income spectrum has burned through that change. But I would also point out that lowest 20% is where it's seen the largest increase in wage and income growth that we've seen since the pandemic. And I'll show a little bit more on that in the next slide. But nonetheless, the bigger piece is that 80% of the US population is sitting on an additional $2.9 trillion worth of cash that, again, I think is going to be unleashed as we move forward here in 2022 and 2023. These are not recessionary sort of numbers, not by a long shot. So as I mentioned, that bottom end of the income spectrum, they've certainly seen wage and income growth. On the left side here showing wages and salaries, this is in trillions, but you saw that we had more than a decade of overall wage and income growth that lagged behind the long-term average. So on some level, this increase in wages that's happened is a bit of a catch-up. Yes, we're quite a bit above the long-term average now, but we're already starting to see signs that some of that's tapering off. On the right side, showing you a little bit different slice of this same sort of dynamic, but you can see that really through the 2000s, largely because of the great financial crisis, we were well below that wage and income growth sort of trend that we were on for many decades. And now we're back into a more, what you would call normal. I know it's hard to say normal anymore, but normal sort of dynamic. And this is probably going to ebb as we move forward. As I mentioned, we're going to go back down to the longer term growth rates as far as overall growth. And we're likely to see that wages and salaries, we have a commensurate sort of taper back down to the longer term growth. We're not going to stay in this area where we've been for the last couple of years, as far as monthly increase in wage growth being over 0.5%. On a monthly average basis. It's likely to come back in the, call it 0.4-ish range, but still better than we were pre-pandemic and closer to the longer term averages. So again, bigger picture, where are consumers and where are they going? We've heard a lot about, particularly in the mainstream media, talking about credit card balances and what have you are increasing and what have you. Let's look at the bigger picture though. We're talking about a 30+ year low in credit card balances that we're coming off of. Yes, they've started to inch up a little bit, but inch up off of a, again, very low base. And if we look at total debt service, and that's what's on the right side, this is total debt service ratio. Yes, we've come off the lows, but we're still well below that long-term average for the prior 20 years. And it's going to take a while for us to come up to it. We are going to see some increases here as far as household debt service. We expect credit card balances, particularly for the low end, to start moving their way higher. We've seen that credit quality has deteriorated a little bit, again, in that lowest tranche. The rest of the income spectrum, if you're looking at FICO scores and those sort of things, continue to be stellar and really reflect this left side of the chart. We're here that, again, overall balances remain low. But as we see interest rates moving up, that total household debt service ratio is going to move higher. But we don't expect it to move or bounce back to that long-term average anytime soon. I mentioned that things like used car prices have started to fade. On the right side here, showing you this is wholesale used vehicle prices from the Manheim folks. Manheim does nearly 85% of all the auto auctions in the US, and they're very attuned to that. We've seen more than a 6% rollback in wholesale prices. That certainly flows through into what happens with used prices. The other piece, which really is a supply chain issue, is that we've seen that motor vehicle manufacturing production has begun to reaccelerate as we've moved into 2022. We've seen that semiconductor production has started to ramp up fairly dramatically late fourth quarter into the first quarter, and that's helping get more vehicles shipped. So on the left side, showing you the number of rail carloads full of motor vehicles that get shipped around the country. Most people don't realize it, but I know you see those car carriers all over the place. Those things only go, call it less than 50 miles. Most of them don't even go that far, particularly if you're in a urban area. But though they take from the rail yards to the dealerships, they don't go really all that far. So they don't come from, wherever the manufacturing plant and get shipped across the country that way. They go by rail. And we see that we've in the March numbers gotten the highest number of rail cars full of motor vehicles in the past 13 months. And we expect that to continue as we move forward. And again, new vehicles getting shipped means those cars get traded in with that transaction, and those become used vehicle inventories. So again, that's, we think, contributing to this 3-month decrease in used car prices that we've seen work its way through. So this is helping with the inflation piece. And I mentioned peaking here in mid 2022. The other one, though, is I've kind of shift gears into the discussion about housing, is despite higher rates, and I know higher rates does impact things, but again, we need to look at things in a more longer term basis and not just say how quickly mortgage rates have come from their lows. They were depressed here for the last couple of years because of what the Fed was doing. And now that the Fed's backing out, we've seen mortgage rates, jump back to the on a 30-year fixed back above, call it 5.25. And people are saying, oh, that's going to how quickly that's happened, that's going to dramatically slow down housing. Not really. And the reason why is we have very tight inventory, and that's what I'm trying to show you here. We've got a 40-year low in the number of existing single-family homes out there for sale. We haven't seen this sort of situation, and it's really gotten dramatically worse as we move through 21 now into 22. That is helping elevate or at least maintain price for existing single family homes. Median, as I'm showing you on the right side, up to call it 380, and it's likely going to stay up. It's not going to be rolling back down, much as I mentioned about other prices. It's going to stay up here, and this tight supply situation is likely to continue. That's also going to mean that regardless of higher rates, you're going to continue to see a lot of housing activity. So looking at it in a different kind of slice, new building permits, and the dark purple on the left side is showing you total permits. And again, not back to pre-pandemic levels, but an all-time high. We have seen in the lighter purple single family permits start to tick down a little bit. I do think that is related to the increase in mortgage rates that we've seen over the last couple of months, that some of these builders are saying, hey, we're not going to be pulling permits right away for some of these single family projects the same way. On the other hand, the teal part of the bar, multifamily, you see that, again, not back to pre-pandemic levels. That's an all-time high on multifamily permits. And as we see this increase in single family home prices, whether they're existing or new, that does push more people into multifamily, think apartments and what have you, particularly in urban areas. So we're going to continue to see, I think, strong construction trends in the multifamily space. Certainly, multifamily is smaller than single family, but again, total housing units will continue to grind higher. The mix is going to be, at least for the near term, probably skewed a little bit more towards multifamily than single family. But again, we've got plenty of population growth. People need to live somewhere. The mix may shift a little bit, but again, overall, you're going to see that housing still has legs. And then as far as total housing starts, again, giving you a little bit longer context here, going all the way back to 1959, we've averaged 1.4 million per year. We were dramatically, and again, can't understate how dramatically we were underbuilding for a decade and a half after the great financial crisis, that one or two good years like 2021 or even 2022, stack them on top of each other, you're still millions of units behind because of that decade and a half of underbuilding. So that's what I'm trying to show you here. We don't think we pop up to that 2.2 sort of range, 2.3 range of the number of units that we saw with the housing bubble. And so comparisons there, I think, are, again, a bit misplaced. That said, it does matter where you're at. Again, I was in South Florida yesterday, and I can assure you there are a lot of cranes and a lot of building happening in those markets. So some of those really hot markets. But I would also throw in places like Raleigh, North Carolina, and Austin, Texas, and even my home market here in Atlanta that are still very strong on the single family side, and will likely continue to do that, but also seeing strength in multifamily as well in some of those areas. Shifting gears a little bit, remodeling, not hearing a whole lot of talk about that, so I wanted to highlight it. We've seen that remodeling activity isn't rolling back the way that people expected, said, oh, that's just because of the pandemic and people are at home and it's just because of work from home. It doesn't appear that that's what's happening. Top right chart there showing you not just major jobs, but minor jobs and even maintenance and repair. They remain quite elevated, again, well above the pre-pandemic levels. And then if we look at two of the other kind of internal pieces, bottom left is the backlog of remodeling jobs that contractors are reporting. And again, that reaccelerated here in the first quarter of 22. And then proposals, which is a leading indicator here, has ticked higher as well. But again, even though it went down in the fourth quarter somewhat, that was still well above pre-pandemic levels. So this reacceleration just points to, we're going to see more activity, not less activity. And again, spoiler alert, that's not recessionary. It is inflationary, but not recessionary. And then last, but certainly not least, I wanted to end on a kind of happier note that things are getting back to normal. As I talk to sales folks around the country in different industries, they've been telling me, certainly in 2020, but also in 2021, that there's no such thing as a cold Zoom call. I know we had a networking event, but there was someone that brought us together. When you're doing sales calls, there's no such thing as a cold Zoom call. They need to be in person. We're seeing a dramatic increase in industry conferences and meetings and those sort of things. Conferences are certainly coming back in a big way in the spring months, but also it looks like bookings into the summer and third and fourth quarter of the year, back half of the year, look strong as well. On the left side here, showing you this is just corporate travel. If we looked at leisure travel, it's not quite back. It's about 3% below the pre-pandemic 3-year average. If we look at corporate travel, we're still, even though we've seen this dramatic increase, and I'm going to go through that in a second, it's still about 27% below the 3-year pre-pandemic 3-year average. But the February to March increase, as you can see that hockey stick that's literally gone parabolic, that's a 47% increase month over month, not year over year, not compared to 2020, month over month from February to March, increase in corporate travel bookings that happened in the US. And I can tell you, again, I'm back on the road as much as I was pre-pandemic, perhaps even a little bit more, but we're seeing that across the board from other folks as we hear things and see the travel numbers coming through. So this is a big piece as we move through 2022 and into 2023. That's going to be a tailwind for economic growth. Again, not just travel and leisure, but everything else that comes with it. People don't go on the road, particularly for corporate travel, because it's a nice thing to do. It's because they make money on it. And so that's going to drive additional economic growth as we move forward. And then last, but certainly not least, is that the number of weddings is expected. This is an estimate, but I don't know about you folks, but I've been invited to a number of weddings over the next few months. And if you talk to the wedding folks, they'll tell you they're slammed. And it's not just making up from the pandemic stuff. It's people that really reassessed where they were and said, hey, I want to do this and I want to have a bigger wedding and I want to and do some other things. So we're going to see this as an additional tailwind, and think about all the economic activity that goes with it. Again, not just leisure and hospitality, not just the meal, it's buying a present, it's getting dressed up, it's perhaps traveling there. There's a lot of pieces that go with it. And then there's associated things, whether we're talking about children and other things eventually, but certainly there's housing that goes with it. They tend to move in together after they get married. That drives more economic activity. So I guess with that, we'll leave it to Q&A and take it from there.
So, Mike, I'll kick it off. I mean, obviously, we've got a conflict going on over here in Ukraine, and there's a lot of questions I get from clients. Is when's this thing going to end? How's the U.S. going to handle that? What's the impact to our economy? What's your take on that?
So there's an inflationary piece, but there's a real piece with the, certainly on the humanitarian side and our involvement. Militarily, these things don't typically get resolved at the negotiating table. I would put that out there. Again, historically, wars don't get negotiated that way. It's likely that it's going to drag on for some time, unless that there's some sort of off ramp that politically a number of these countries, including the U.S., are able to somehow broker. But it does sound like Russia, at the very least, wants to have some sort of takeover of a part of Ukraine. Whether that's acceptable to the West and to the Ukrainians remains to be seen. But again, I'm not a political scientist, but it does appear, listening to those experts, that this isn't going to be resolved rather quickly. From an economic standpoint, with commodity prices, as I mentioned, we're seeing some dramatic increases in commodity prices, particularly energy, especially with respect to Europe. So let me hit that piece kind of separately, if you will. So there's a couple of pieces to understand. Europe and parts of Europe are very much going into a recession through the course of 2022 and perhaps the beginning of 23 because of energy prices. The other piece of it is not just energy price increase on itself, is not being able to generate enough energy production to maintain production for various factories and what have you. So that's going to contribute to it. And then thirdly, supply chain disruptions. And again, Russia, about 40% of natural gas that Europe needs for its electric power generation comes from Russia. So if they politically, it might be the right thing to do politically, and morally and what have you, but they're going to cut off one of their legs economically by doing that. So if they need to do that and they do it, they're going to end up impacting the European economy. But let's be very clear here. As we saw in the recovery after the great financial crisis, the US had an 11-year run not going into a recession until the pandemic recession that happened in 2020. Europe was in and out of recession during that period, including a number of countries. And I'm thinking of certainly places like Spain, Italy, Greece, that were in and out of recession in all three of those cases 3 times, while the US didn't go into recession at all. And Europe as a whole went into 2 recessions. So if you look at just the EU numbers. So again, it's important to remember Europe can go in and out of recession, and it not that we're not affected at all, but it doesn't necessarily mean or spell that the US has to go into recession. So these, if they do it, then we have to do it, sort of talking that I'm hearing by folks, even within the financial press. It's not rooted in facts of what happens. Again, 2/3 of the US economy is the US consumer. So unless there's something that's impacting consumer incomes and consumer spending habits dramatically that way, and yes, inflation is an impact, but it doesn't spell a recession. The other piece that I think is really important, and I'm giving this a long answer, but it's an important point to make. Inflation can contribute to a recession, but inflation doesn't cause a recession. And that's an important piece that I think, again, a lot of people are driving right past and saying, well, if we have inflation, we're going to have a recession. No, because then if that were the case, places like Argentina, where they have 10 and 15% year over year inflation stacked on top of each other year after year after year, or places like Turkey that year after year have 10, 20% inflation, they would be in a constant state of recession, but they're not. Again, inflation can persist, and it hurts us, and it hurts our buying power and all those sorts of things, and it hurts real growth, but it's not recessionary. It doesn't cause everything to stop. It hurts. It's painful. We don't want to go through it, and it disproportionately hits people on the low end of the income spectrum. And you see credit quality issues that happen because of that. Absolutely. But it doesn't cause recessions in and of itself.
All right, very good. Thank you. Tim, I believe you have a question. You have your hand raised.
Yes, I just was wondering about the recent China shutdown of ports and restrictions over there. Do you view that as impacting the U.S. economy like the supply chain thing did to us when we had our port shut down? Is it the same kind of phenomena that we're looking at?
It is, Tim. Good question. And another very nuance. We got a lot of nuance in here. Sorry. The Chinese vaccines are not the same as the US vaccines. They're not nearly as effective. So that's an important piece to remember as well. Then a lot of people are saying, well, geez, if they're shutting down, then we could get whatever strain they have, and that's going to cause a US shutdown. That's not in the cards. Another piece that's really not been talked about, 75% of Americans over the age of 5 have gotten fully vaccinated, and more than half have gotten a boost. So again, our healthcare outcomes have been different than what's gone on in China. And the other thing that China has done is this literal zero tolerance policy that the US obviously isn't in, and the rest of the world hasn't been following a zero tolerance sort of situation. So our health outcomes specific to not just the COVID, but also Omicron variant, among other things, has been quite different. It does cause supply chain backups. So if you're looking for that, washing machine or appliance that may have Chinese parts, or is assembled in China, yeah, there's going to be some impact, definitely. So that's going to be inflationary. It does appear that it's going to be rather temporary, but it will be inflationary and have an impact on consumer good prices here in the US. Good question.
We have a question in the chat. What will inflation look like in the fall around the elections?
Well, it'll be coming down by then on an overall sense. Though I do expect that we're going to continue to see high crude oil prices, which means high gasoline prices. Again, I'm not a political scientist. This isn't a political discussion, but the single most correlated economic factor to presidential approval ratings, and it's tightly correlated, and it goes back 75 plus years, is gasoline prices is tightly correlated to presidential approval ratings, which also, when you think about presidential approval ratings and what have you, when people are unhappy, they tend to want to pitch out the party in power. And that's what typically happens during midterm elections. So I wouldn't be surprised to see that sort of scenario work its way through as well because of higher gasoline prices. Again, think about gasoline prices in general. It's the one price in our entire life that you drive by and there's a big giant sign with it, with the price on it. Nothing else has a price on it that you could drive by and see. We don't put milk prices. It used to be in the bad old days that you would see some motels and what have you would put price. Even they don't do it anymore. No one puts price up there but gasoline, and we're very, very sensitive to it. That said, we do have the wherewithal to make it through the vast majority of folks because of that, whether it's the cash buffers that I mentioned, but also wage and income growth. Again, for the vast majority, we're going to grumble about it, but we're going to fill up our SUV nonetheless.
And then there's another question in the chat. Any comments on healthcare costs?
On healthcare cost. So healthcare generally had lagged quite a bit in the speed of the recovery outside of acute care, emergency rooms, those sort of things. But we're seeing a fairly dramatic increase in medical services, healthcare services ramp up. This began very much in earnest in late 2021, but we're seeing this continue in 2022. I mentioned earlier that consumer spending is roughly 2/3 of the US economy. Almost a quarter of the US economy is healthcare services specifically. So this comeback, this getting your teeth cleaned by your dentist and other things, medical services generally, that's a big impact on the economy, and we expect that to continue. As far as cost, though, we continue to see that healthcare employment, while it's rebounded, the churn or the turnover in some of these sub-industries, particularly in the nursing, long-term nursing, really is a problem. They're seeing dramatic increases. Some of it, I think, was specific to the pandemic, where you saw people were forced to work or caused to stay long hours and what have you, partly because some of their coworkers had been infected, or some said they didn't want to come in because of COVID and they were worried about it, or people just outright quit. That just put even more strain on some of these nursing care facilities. But again, it's come through in the numbers that the churn within long-term nursing facility employment continues to be very high. So they're having to pay up to try to get more workers or attract more workers. And that's having an impact, again, particularly within long-term nursing facilities. Overall nursing numbers and overall healthcare numbers were above pre-pandemic levels as far as total employment, but the wage numbers that we're getting from the Bureau of Labor Statistics does show that they're not seeing additional wage increases that are not, basically the same sort of numbers that we're seeing across the economy, roughly in the 5% level. Yes, that's elevated, but again, they're not seeing it worse than, let's just say, leisure and hospitality, where they've seen wage increases closer to 7% on a year-over-year basis. So, overall healthcare costs likely are going to continue to move on the long-term trend, which is to say, healthcare costs were really the last 15 years, 20 years have been trending above overall inflation anyway. They're going to continue to stay that way, but they're not going to be as above where overall inflation is going forward. So again, back to the long-term trend sort of numbers.
All right, very good. Mona, what's our hard stop? We've got some other questions coming in here. What is it 9:30 our hard stop?
No. Generally about 9:30, so we have time.
Okay. All right. Tim, you have your hand up. Is that from before, or do you have a new question?
How about trends towards economy green friendly? Ooh, that's
from before.
Oh, can
I got to figure out how to take it down here. So.
Okay.
All right. That's fine.
So you don't want me to talk about EVs? Because that one's important when we talk about energy.
Love to hear about it.
Go for it, Mike.
So I mentioned auto production and some of those things. I am very much in favor that we need to shift our powertrain from the internal combustion engine to something else. I'm not necessarily convinced that we have the correct technology yet, based on what we can produce. That's an easy way to say it, but unpacking that a little bit, you'll start to see what I'm talking about. Less than 2% of overall sales today for consumer vehicles is electric. We can't produce enough batteries today, and it's less than 2%. So all of these people that you're hearing say, by the end of the decade, we're going to get to X percent. It's not a thing. We can't make the batteries, no matter what magic wand or the government says you have to do it. China can't do it, and the government makes, they make those decisions for them. We, the world, cannot produce enough electric vehicle batteries. We don't have the lithium mining and production capabilities. It's just not a thing. So we're going to probably need to get to some other form of powertrain. Maybe it's hydrogen, maybe it's something else. I would posit to you that it's probably more likely that you're going to see a continued push into hybrid. And this is some in the auto industry call it traditional hybrid, whatever way you want to say it. It's basically, it's a battery setup with some sort of internal combustion engine, and it dramatically increases the miles per gallon. We're likely to continue to move down that path rather than going to a fully electric sort of scenario. And I know with the Russia situation, a lot of people are talking about that and saying, hey, this is the reason why we need to go to EV. But again, we can't produce the batteries. And then just a quick math thing. I know it's a little early in the morning to go down the math path, but work with me just for a second. We've never sold more than 18 million vehicles. It's about a little over 17.5 million is the most we've ever sold in any given year ever in the United States. But let's round it up to 20 million just for the sake of argument and make that math easy, because again, it's still roughly 9 o'clock East Coast. So let's just say it's 20 million, and Mike has his magic wand and he says, from now on, from April 28th, 2022, every vehicle will be, somehow we made the batteries. Every vehicle sold after today will be an electric vehicle. Yay. How many years is it going to take us to replace the current fleet of vehicles? We have 260 million vehicles, passenger vehicles in the US. At 20 million, how many years is that? Anyone? It isn't the end of this decade, and it is until the middle of the 2030s. And that's if every vehicle from now on was an EV. It's not going to transition that quickly, people. Not going to transition that quickly. And as I mentioned earlier, it's likely to move more down the path of some sort of hybrid sort of technology. We didn't talk anything about heavy duty vehicles, which need more power and batteries really aren't a thing. And we didn't talk anything about aviation. Aviation, if you put that number of batteries, according to the engineers, and I'm not an engineer and I didn't stay at a Holiday Inn Express last night, but the engineers say you would need to put literally an additional 1 million pounds of batteries onto a standard Boeing's 757 to try to get that sort of lift. It's an engineering problem. You can't do it. So even if you could make those batteries, you couldn't get that much lift. You just make the plane too heavy. So that's a sizable chunk between heavy vehicles and aviation, that even if we solve the consumer passenger side of the EV problem, we couldn't do on that side. We need some sort of other technology or some other way of doing it. I'm not poo-pooing the idea on its face that we need to move from climate change perspective, and certainly from a political and military perspective, because energy independence and security really is a national security issue, not just for the US. The Europeans are now seeing that in spades. Again, we just don't have the technology to get there.
All right, there's a couple other questions in the chat here. All things being equal, i.e. like location, if an individual was tempted to sell their PA home and rent, would they be able to take advantage of this market? What's your sense on how long this housing bubble will last?
I don't think we're in a bubble, again, based on where the long-term trends are and the amount of underbuilding that we did for the length of time. That's not to say that parts of PA, and certainly, and I have a lot of family, and you can tell by my accent, I'm not originally from Atlanta. I'm from Cleveland, Ohio. But if you look at places like Cleveland and Buffalo, Detroit, places in the Rust Belt, they're not experiencing a housing bubble, not by a long shot. In places like Cleveland, they're still not back to the pre-great financial crisis housing bubble period price levels. So just noodle that for a quick second. But the question was specifically, if I sold, and I'm not giving specific advice, this is a hypothetical, but if somebody was asking if they sell their PA house and then rented, are they renting in the same market? Because that makes a difference. If you're renting in the same market, unless you're downsizing dramatically, then it could certainly make sense to do that arbitrage of, I sold my house at, I sold high and I rented low. Yeah, of course that would certainly work, but that would work in any environment. The other thing is, if you're selling in PA and you're going to, I don't know, I was just in Fort Lauderdale, so we'll pick Fort Lauderdale. Yeah, you're going to pay dramatically more, whether you're renting or buying or what have you. So it really does depend where you're going. Now, if you go from, PA to, perhaps a more rural area, yeah, it's likely that you're going to get some sort of arbitrage there. But housing supply generally is so tight, even in some of these not so hot markets, that you're likely to sell high and have to buy high. So and whether you're renting or buying, it's still the same sort of dynamic generally, that there's not enough housing units. So unless you're downsizing, it's probably not going to work to your advantage.
Will new cars compete against the price decrease of cars?
Will new cars, I mean, like price increases on new cars?
The question reads, I like to see used car prices come down because that's my preferred way to buy cars. Will new
Sure.
cars compete against that price decrease?
It has been for the last year plus. So the differential between used car prices and new car prices, that's been driving some of the new car purchases, as people are saying, normally there's a bigger gap there between a new and used. So let's just pick a generic vehicle, a Toyota Camry, or a Highlander or a 4Runner, kind of mainstream vehicle. And you say, what's a brand new 2022 cost versus a 1 or 2 year, and the typical is a 2 year coming off of a lease, similar vehicle, decent, or maybe even low miles. What's that price differential? It's a few $1,000s, and you say, hey, I can save $5,000-$10,000 by buying that vehicle. If we price adjust for it. The difference is that recently, because used prices have been so dramatically higher, that in a lot of cases, particularly that 4Runner example that I used, a used 2-year-old 4Runner is more expensive than a new. So that's been driving people to just say, well, I might as well buy the new one. I'm getting additional warranty. I'm getting additional features. That's been a dynamic, and it's likely to continue here, at least somewhat in the near term, depending on the vehicle. If it's a sedan, for the most part, this pricing differential piece is likely to unwind as we move through the summer months. These spring months, particularly February and March, which is why it's so important that we're seeing prices decrease, wholesale prices decrease in February and March. Normally, these are very strong buying months, particularly for sedans. Sedans are typically purchased by lower end consumers, and those lower end consumers use their tax refunds as the down payment. And we've continued to see that. That's certainly the case in the early buying season here in 2022. But we've seen it somewhat soften. So that's at least from a inflation standpoint, a good dynamic that's going to probably bode well as we move through the year. That said, if you're looking for whatever the hot vehicle is, yeah, there's probably not enough of them. It's likely to still be the case that buying new is probably going to be preferential to trying to buy a used vehicle. Again, for the most part.
Good. Another question. What do you see for stock market investments over short and intermediate terms?
Yeah, so there's a number of pieces there to unpack, but very, very quickly. We're likely to continue to see choppiness in stocks as we move through, certainly this earnings season currently, but as we've noticed, no one seems to care about the actual earnings. Earnings have held up for the most part, with the exception of a few and again, not talking about individual stocks here, but Netflix and others, it's been widely talked about. But for the most part, earnings have been quite good, and the market's been ignoring them somewhat because of the expectations of the Fed maybe raising rates too quickly, and this whole narrative of the Fed over tightening and causing or pushing us into a recession. Again, I think that's largely misplaced. Starting points matter. They're coming from zero interest rates, et cetera. But that is injecting quite a bit of volatility into stocks. So you're going to continue to see this choppiness. So near term, it's likely to be choppy, but over time, and I'm talking about months here or even quarters, stocks follow where earnings go, and earnings continue to grind higher. And important but nuanced point here, earnings are nominal, they're not real. So price increases and what have you, yeah, earnings are going up and they continue to go up, and stocks generally follow earnings. So you could see some, whatever you want to call it, disconnectedness that we've seen certainly through March, back half of the first quarter. and into April thus far because of the war and increases in crude oil prices, worries about inflation, worries about a recession, worries about the Fed. That's a lot of worries. That said, I think one by one, as we move through things, you're going to continue to see that one by one, stocks start following earnings again where they're going. So longer term, we think stocks are going to do well. Near term, they're going to be, it's going to be choppy. So don't be surprised to see more downside in the near term.
All right. And last question I have is, we're having to raise wages and our contract constrained, i.e. we can't renegotiate our contracts midstream. What's your prediction on the talent shortage?
Well, it depends on the type of talent we're talking about. If it's contract, I'm assuming that it's not low-end wages. But we are seeing some things as far as labor market dynamics, things like the participation rate, so labor force participation rate, and we're seeing people come back in. We've seen that 6+ months now where the labor force participation rate has been moving up. There's more people coming back into the workforce. So there's a couple of dynamics there. One has been particularly prime age working women, females. And the cause there was, why was labor force participation depressed for women, was because of either A, healthcare, or B, childcare. But most of those things have been largely repaired for the most part. So schools are all back in person and what have you. So those things have alleviated. I think the bigger piece overall, though, and again, this is men and women, the increase of older workers coming back into the workforce. There may have been some trepidation early on with COVID specifically, but also people taking either early retirements voluntarily or involuntarily during the early part of the pandemic. But we're seeing some of that alleviate. The other thing is that there were fairly sizable stock market gains that happened in 2020, and some people quit their jobs, or if you will, retired early, and that have come back and said, I'm in my late 50s, early 60s. I quit early. In fact, the Wall Street Journal had an article about this in the last couple of days, talking about this phenomenon specifically, where they said, I had the money, I don't need to work. But need to work is more than just the wage that you get. And we actually talked about in one of our breakouts about people, going into something else. Maybe they went into franchising or something. They did a different chapter. They quit what they were doing for 20 something years that made them a bunch of money and said, hey, now I don't have to work, but maybe I want to work. I even saw this with my own mother, into her mid 70s. She was a nurse. Her house was paid off. Her cars are paid off. She didn't need to work. Really, it was just her, vacation money and what have you. But she wanted to work, and they wanted her to continue to work. So that's kind of a symbiotic thing. And for a lot of people, men and women, work is something that you need, just not just for the money. And so we're likely to continue to see churn between industries and jobs and what have you. But it's likely to see that we're going to continue to see this labor force participation rate sort of phenomenon, and people coming back into the workforce continue. It remains somewhat depressed. So unfortunately, we can't help that. Whoever was asking the question about their contracts. And again, that's one of the sticky parts of contracts, is it gives you the certainty that, hey, we've got this locked in, and we're not going to see fluctuations in the demand for your service. But the other side is you're stuck at that price for that locked in period. So it's a double-edged sword, unfortunately.
All right. Well, Mike, thank you for your time. It was super awesome presentation. Good, thorough answers. We certainly appreciate it, and hopefully we can have you back again. So Andy, you want to go ahead and close us out?
In person, maybe. In person.
Yes.
No, I'd just like to add to what Kevin said, Mike, really appreciate that. It was very interesting, very informative, and I guess things are potentially not quite as bad as you might read in the press, which is good. Yeah, we'd love to have you back at some time.
Beacon is the premier executive networking organization serving the Mid-Atlantic region. To learn more, go to beaconforlife.org.